the easiest way to accurately value a stock. Hi, my name's Hamish Hodder, and in this video I'm going to show you exactly how you can put a number on the price of a stock that you've been looking to invest in. If you've looked into a couple of businesses, you found a couple really great businesses, but you don't know what price you want to buy them at. You don't know what price is overvalued, you don't know what price is undervalued. You have all these analysts giving you different numbers, and you want to work out for yourself a target price that you can work towards and say, all right, when my stock hits that price, that's when I'm going to buy it. This is the 5th video in a series about low-risk stock market investing. If you haven't seen the others, I'll put an annotation up there to the playlist. You can check them out. If you haven't already, make sure you subscribe and let's get into it. So this is a method of doing an intrinsic valuation on a company, and it's really easy. All you need is 4 things, 3 of which are just given to you. You just have to go on a stock market website or a finance website and find the number. And one of them you have to do a little bit of legwork, but I'll run you through exactly how we do it. And I'll give you an example when I finish the Google case study at the end of this video, showing you exactly how much I think Google is worth. So all you need is those 4 numbers, and then we need a compound interest formula, which I will give you. And that's all you need. It's really easy, so let's jump into it. So you're going to need 4 things that are going to fit into a formula that's going to find us what our buy price is. And I'm going to chuck the formula up on screen because it's a little long and it looks scary, but don't worry, I'll break it down very simply. So what we've got is we've got the earnings per share, and we're going to times that by 1 plus the growth rate to the power of 5. That is all times by our PE, or earnings multiplier. And that's going to give us a future price. And then all we're going to do is divide our future price by our required return multiplier. And that's going to give us our buy price. So let me break it down a little bit to make it easy for you. So the formula starts off with earnings per share. That is one of the 4 numbers that we're going to need to find. It's really easy to find. You just go on a finance website and find it, and I'll run you through that in just a second. The next thing we're going to need, as you can see, is growth. And what I mean by growth is we're going to need to pick a number that we think the company is going to grow at over the next 5 years. So that's a number like 15% or 20%, whatever we estimate, and I'll show you how we estimate that in a little bit. Whatever we estimate, we put that into the formula there. The reason we have a 5 at the top is to the power of 5 is because we're going to be looking out 5 years into the future. So we're going to be projecting a price out 5 years into the future. So then you have the PE ratio. So this is the PE ratio that we think a company will have in 5 years when we're going to be selling this stock. So that's going to give us a future price. And by future price, I mean the price that we think the stock will be at in 5 years. So this calculation is going to give us a price that we can say, all right, the stock is going to be there in 5 years' time. From there, all we have to do is divide it by our required return multiplier, which I'll show you exactly how to do. It's really easy. And that'll give us what price we want to pay today in order to see the returns that we want when the stock price reaches that 5-year price in 5 years. So let's start out by talking about earnings per share. So this is no work required at all. Whatever business you're looking into, you can jump over to the Wall Street Journal, that's WSJ.com, and you can just type in your company's details. And on the summary page, it'll give you the trailing 12-month earnings per share. So that's the earnings per share from the last 4 quarters, whether or not that's all 2017 quarters or that's maybe 3 2017 quarters and 1 2016 quarter. So the next part is we're going to look for the growth number. And this is the hardest bit, but it's not that hard, and you just use a calculator that I have a link to in the description, and it's very easy to do. So basically what we're going to do is we're going to get 2 growth numbers so that we're being accurate, and we're going to compare the 2, and then we're going to pick the lowest number. And the reason we do that is because we want to be conservative. We don't want to come up with a growth number that's too high and unrealistic. So we're going to work out 2 different growth numbers in 2 different ways, and then we're going to pick the lowest one. So the first number is really easy. It's the 5-year analyst forecast for the company. And you find this on Yahoo Finance. I'll be showing it on screen right now. And you just grab that number, and that's our first number. Easy done. The second number is a little bit trickier. So we're going to have to do some maths here, but we can use a calculator that I've linked in the description. Basically what we're going for here is we're going to grab the long-term equity growth of a company, compounded, not simple. So we're going to need a calculator to do this compound interest for us. I've linked it in the description, and later in the video when I'm doing my Google example, I'll show you exactly how you do it. But basically what you do is you take this year's growth number, then you take a growth number from sometime in the past. The longer you go, the more accurate it is. So if you go from 10 years ago till now, it'll be more accurate than if you go from 5 years ago till now. However, if you want to do it the easiest way, you can just grab the five numbers that are on the Wall Street Journal. You only need the 5 year ago and the current year. So basically what the calculator is going to do is it's going to work out from 5 years ago to today what is the compound growth of its equity. And whatever number that the calculator spits out to us, that's our second growth number. And remember, we're going to take the two numbers, compare them, and pick the lowest. And that's it. That's the hardest bit, guys. That is the hardest bit. So number 3, the PE ratio. This requires no work at all. All we're going to do is we're going to compare two numbers again so that we can be conservative. We're going to compare the 5-year average PE ratio, which is found on MSN Money. I'll be showing it on screen right now. And we're going to compare that with 2 times our chosen growth rate. So for example, let's say we chose 15% for our growth rate. Then our second number for our PE would be 30. 2 times 15 is 30. So then we have our two numbers. We have our 2 times growth rate PE, and we have the 5-year average PE, and we're going to compare them, and we're going to pick the lowest in order to be conservative. So lastly, we need to pick our own personal required rate of return and multiplier. And this is going to be different for everyone. However, you can just use the one that I use, and that'll make it very easy for you. Basically, what we're looking for is we're going to work out what kind of return we want. If we want to see 15% per year over 5 years, that means that we want to double our money in 5 years. So what that means is we've got a required rate of return multiplier of 2. If you want to see 10% returns per year over 5 years, that's a multiplier of 1.6. If you want to see 20% returns per year, that's a multiplier of 2.5. Now, we're not just going to take 2, 2.5, or 1.6. We're actually going to double that number. And this is because we want to allow for a big 50% margin of safety. And what I mean by that is, if we double our required rate multiplier, then even if we estimate our value twice as much as the company is actually worth, if we get it wrong by an entire 50%, then we will still get our return, whatever we choose. If we choose 15, we'll still get 15. And the great thing is, if you're accurate in your valuation, then you will get double whatever return that you wanted to get. If you wanted to get 15%, instead you'll get 22%, which is 4 times your money in 5 years. So that is all you need, just those 4 numbers and the compound interest calculator. Now I'm going to run through an example on my computer of Google. In my previous video, I worked out that Google was a company that we would be willing to invest in. And I'll link that somewhere, probably in the description. And basically, the video told us that it's a good stock for us to invest in. However, we don't know what price. And in this example, I'm going to show you exactly what price you should be willing to pay for Google stock. Okay guys, so we're over to my computer now for the live example. As you can see on the right, I've just written up what sort of numbers we're going to be looking for, the 4 numbers that we need, and then the formula below it. So for Google, I apologize for using Google as an example because due to the recent tax changes that Trump did, Google actually brought a heap of money from overseas back into the United States and paid a big one-time tax. And because of that, their latest numbers, their latest earnings per share is a lot lower than it actually would be without that one-time tax hit. So I'm actually going to be using different numbers than the ones that are on the Wall Street Journal. So the first number we need is earnings per share. And so we'd come down onto Wall Street Journal, we'd search Google, and here it is. And the earnings per share is just here. However, it's 18. Without the tax, the one-time tax hit, it would have been $32 per share. So that's the number that I'm going to use there. So I'll put 32 in there. So next we've got to calculate the growth number. So we're going to need this website. The link is in the description below. And we're also going to need the Wall Street Journal. So we're just going to click here, go to the balance sheet. And as you can see, it's from 2013 to 17. So that's 1 year, 2 year, 3 years, 4 years of growth. So that's going to be 4 years in there. So I'm going to scroll down and open this, liabilities and equity. And as you can see, here's equity. So this number 87,309 is the 2013 number. And this number 152,502 is the 2017 number. So we're going to take that number, and they're already in there, but I'll just do it anyway. Put it in there. And the latest number, and put it there. And we'll get rid of these commas. And then we're going to execute that. And that's going to tell us that the growth rate over the last 4 years compounded was almost 15%. So the growth rate we're going to use is 15%. Really easy, guys, really easy. PE ratio. So then we're going to jump over to MSN Money. So I just Google searched MSN Money and then Google, and it came up. And this will be the page that'll load. You want to go to Analysis, and then Price Ratios. And down here you'll see we've got the 5-year high and the 5-year low. And from that we can get the average really easily. So I'll just get my calculator. We type in, so we'll go 66 plus 27 divided by 2, and that'll give us the 5-year average, 46.5. But remember, we're not going to use just that, we're going to use that or 2 times the growth rate if that's lower. So 2 times the growth rate is 15 times 2, which is 30. So we're actually going to use 30 instead of 46 because we want to be conservative. And finally, for our required rate of return, I'm going to say that I want to double my money in 5 years. So I want 15% per year returns. And so that's a 2. And remember, we always double whatever return we want in order to be conservative. So we're actually going to use a required return multiplier of 4. So they're the 4 numbers that we need. We've got 32, 15, 30, and 4. So now let's put them into the formula. So when doing the formula, it's important that you do this bit first because that's the bit with the tricky to the power of 5, and we want to get that out of the way. So we come over here. So we're going 1 plus the growth in decimal, so 0.15, 1.15. And you just click this one here with the X and the Y, that's to the power. And then 5 equals. And then we're going times by our EPS, so times by 32 equals. And then times by our PE ratio, which is 30. So times by 30. And that gives us what our future price is. So what price we think the stock will be at in 5 years. And to get the buy price, we just divide that by our required rate of return. So divided by 4. So our buy price is $482.70. So we'll put that in here. $482.72. And that's it. So you're probably wondering, that is a lot lower than, if we go back up here, that's a lot lower than the current stock price. The current stock price is $1,100. So that's about 60% cheaper. And yeah, I know that's a lot, but what it's important to realize is that at the moment, with the current state of the market, a lot of stocks are really overvalued, or they're at a price where they're not cheap at least. They're either at their value or above. And what that means is we need to write down this price, note down Google, keep it in a list, and when the stock prices go down, say in a recession, there's probably going to be a recession over the next 5 years, it's pretty likely, I would say. Stock prices will go down, maybe 20, 30, 40, maybe even 50 or more percent. And then stocks like Google will come into the buy range. And if we bought this stock at $482 a share and it performed at 15% growth per year, which is very reasonable for a company like Google especially, in 5 years we would have 4 times our money, which is an excellent return. That's about a 22% return. So that's it, guys. How easy was that? That is how you can accurately put a value on whatever company you're trying to invest in. Now, it's important to remember that this only works accurately if you've picked a good business to invest in. So make sure you check out that other video in how you can decide whether or not the company that you're looking into is a good investment. If you have a good company, then using these sort of numbers will be accurate, and you will be able to find great companies at great discounts and make great returns into the future. Thanks for watching, guys. I hope you really enjoyed this video. Leave a comment, let us know your thoughts. What kind of things do you do to value a company? Leave a like if you haven't. Make sure you're subscribed if you haven't already, and I'll see you in the next one, guys.